Repo madness. Everything must go. Repo madness. We'll buy anything for sale. Repo madness. The Fed is in control. Repo madness. This is not QE. Repo madness. It's the Twilight Zone. Repo madness. I'm Mugatu. Repo madness. Welcome to dystopia.
So, I made that funny little clip for you guys. It really is repo madness. Everything must go. You know, in my crazy infomercial voice here, my used car salesman voice, tried to do that. There's a funny little special effects website that changes around your voice. Not only did we have the Fed cut rates today, a quarter basis point, which was expected, and the dollar did actually rise counterintuitively, so this would feed Brent Johnson's dollar milkshake theory that more money is coming to the U.S. It's going into the dollar index. The dollar index was in the low 98s yesterday. It's now up 0.32 up to 98.58. So even with a Fed rate cut of 25 basis points or a quarter of a point, the dollar index still rose because on a relative basis, the European Union is trying to cut rates more, trying to do even more QE. The Fed has not officially done QE yet. I'm going to try to keep this explanation as for people who are not sophisticated financially, who are not financial professionals, as easy to understand as possible. So technically, repos, and there has been $128 billion worth of repos now in the last 48 hours, and I'm sure there probably will be more. I'm not sure how much will be announced, but things have gone haywire in the last 48 hours. Even yesterday, I believe the Fed tried to make $75 billion in repos available. These are repurchase agreements. So there's an Investopedia definition of it. I'll attach it in a link to that, and I'll explain what a repurchase agreement is, but I'll just call them repos. I'm going to try to explain this in as easy to understand terms as possible for people who are not sophisticated, who are not financial professionals. So technically, guys, this is not QE, okay? Because this is technically the Fed is not officially expanding its balance sheet, monetizing debt, creating new currency units to buy assets out of thin air. Technically, this is a loan with collateral. So technically, the banks that are borrowing in repo overnight, and we had the overnight repo rate, which is the repurchase agreement rate, it went up fourfold on Sunday night into Monday, and things started going haywire then. And it was, I think, in the low 2 percentage point, 2% something, and then it went up to 10%. That's a crazy chart I have there. It's a 4x move in a very short amount of time, and the Fed panicked. So for those of you who are saying that the Fed is completely and totally in control and that everything is going according to plan for the Fed, I would completely and totally disagree with you. This is not something the Fed wants. Okay, the Fed totally screwed up here. I could use a lot worse phrases and adjectives if I wanted to make a joke about this, but a repurchase agreement is different from QE, where the Fed does give the banks currency. However, the banks are selling the Fed something with collateral. So the banks have the right to repurchase, and that's why it's called repo. And then there's reverse repo, where the Fed can take liquidity out of the system. But the banks have the right to repurchase the assets, and I'm using air quotes, because in good times with repo agreements, the banks will use good collateral, much better collateral, treasuries. In bad times, what will happen is in 2008, where the amount of repos, I have a chart up here. I still haven't figured out how to put multiple charts on OBS without crashing the thing. I use OBS. People are like, oh, you should download OBS. I have OBS. I tried testing out multiple charts. I have a chart in the Wall Street for Main Street Facebook group, and it shows the spikes in repo per month. And the repo spikes went crazy in 2001. They went up to $400 billion per month in repo. So that was the Fed bought back $400 billion in collateral. So it's technically not QE because the banks that are getting emergency loans and emergency liquidity programs from the Fed are allowed, they're technically allowed to buy back the assets, and I'm using air quotes, depending upon what type it is. They have to put collateral. They're technically allowed to buy them back for the emergency liquidity program draw that they got. However, in bad times, they normally don't buy any of the stuff back. And this was the case if you look at the chart from 2007 to 2008, the amount of repos per month spiked to 200 billion, then to 300 billion. There was a little dip between the end of 2007 and 2008, and then it went all above 350 billion and then over 400 billion before the Fed stepped in and did QE. So massive spikes in repo, in repurchase agreements, in emergency liquidity programs are precursors to QE program. So I would watch for even more repo lending spiking. So the Fed was able to calm down that 10% repo rate borrowing. But technically this is not QE because the banks do have to give the Fed collateral or some type of asset in order to draw from the liquidity, to get the emergency liquidity programs. Okay, so hopefully I explained that in much easier to understand terms. So in good times, the repo collateral is treasuries. In bad times, in 2007 and 8, it was mortgage-backed securities. So the Fed was buying mortgage-backed securities, collateralized mortgage obligations, and other toxic nonsense that was not good collateral, and the Fed was buying this stuff before QE officially started in 2008. And that's why the repo rate spiked. My educated guess about what's happening now, there's a number of theories. Luke Groman is citing on his Twitter, he is more of a, I would say, dollar bear and more of a China bull. And he's citing this chief market strategist at another investment group that's saying that it's the amount of treasuries that need to be sold and that there's 45 billion net treasuries. Is it per week or per day? It's a massive amount of treasuries. 45 billion per day in U.S. treasuries gross issuance. That's what Luke says. And he thinks that this is the amount of treasuries that the U.S. has to sell by the end of the year. My educated guess would be something different. My educated guess would be that this could be subsidiaries, potentially, this is just an educated guess, could be subsidiaries of European banks that have American locations, and so Deutsche Bank or Credit Suisse or some of the other European banks, maybe other German banks or other French banks or other Swiss banks, and they have American locations and they have access to the repo here in the US with their American branch. And because they're not getting enough liquidity in Europe for their derivatives positions or collateralized loan obligations or other counterparty risk, then they're drawing it here. So the Fed apologists, so the people who always defend big government, always defend the Federal Reserve, always defend one or both political parties, always defend Wall Street because they work there and make a lot of money there, they will say that this is not QE, the Fed is taking collateral in, but the truth is we don't know the type of collateral they're taking in. So they could say it's treasuries from banks, but most likely it's probably not treasuries. Most likely it's probably some type of toxic garbage. So it could be collateralized loan obligations. The worst toxic garbage that I have seen lately is the collateralized loan obligations, which is chopped up junk bonds with covenant light, with little or no debt covenant, and the default rate percentage, the likelihood of default rate is very, very high. So this also has to do with IOER, which is interest on excess reserves. And when the Fed started the rate cuts, and by the way, the U.S. is still technically in an economic expansion, so the Fed has now done 2 rate cuts without an official recession, which is it's setting history, because normally the Fed waits until afterwards to start cutting rates. So that's why we're back into the same mistakes of the 1920s and 1930s. But when the Fed started cutting rates back at the end of July, the first rate cut, they also cut the interest on excess reserves. And when the Fed cut the interest on excess reserves, there was over $1 trillion docked at the Federal Reserve collecting interest. And the Fed apologists, the people who defend Wall Street, the people who defend the status quo, the people who defend the Federal Reserve, the mainstream financial people, the mainstream media, the mainstream financial media, they say that the Fed did not monetize debt, that the Fed could unload their balance sheet, that all those reserves that the banks had there was not inflationary. But they don't understand the banking system, or they're either number one, they don't understand the banking system, or number two, they're just straight up lying. Because the way the banking system works is once there's reserves in the system, even if the reserves stay at the Fed, and a lot of people claimed that there was no inflation. I hear this every day still, that the Fed created no inflation, that because the banks kept almost all the reserves that were created in QE at the Fed earning interest, and they just either don't know how the banking system works with fractional reserve lending and how the reserves can be used as collateral for all kinds of loans, all kinds of bets, all kinds of speculations, all kinds of gambles, all kinds of derivatives, hedges and trades and bets by the banks. They just either don't know or either they don't know, they don't understand, or they're straight up lying. There is no fourth scenario. And so the reserves that were docked at the Fed, as the Fed started to lower the interest on excess reserves, that money started to leave being docked at the Fed, and it started going into other gambles and bets. Because the large banks were not being incentivized to keep the capital there earning interest. But the dollar bears and the China bulls are saying that this has to do with a potential default at a U.S. Treasury auction. And I haven't really seen any evidence of that yet. There has been some weakness in some of the Treasury auctions, and some of the Treasury auctions were good. Gold is holding up around 1,500. Let me look at the yield on the 10-year. The yield on the 10-year, I think it got as high as 1.8 something yesterday, so it's been knocked back down, I think, to 1.786. So it's down almost 1.5% today. Let me take a look at the chart here over the last week. Yeah, so on Friday, September 13th, it got as high as 1.9, according to this very briefly. So there's a bunch of articles. In my opinion, someone's asking about CLOs. In my opinion, eventually there's at least $600 billion in CLOs, and we don't know the amount of additional derivatives that could be attached to that. So there could be trillions more in extra derivatives attached to the collateralized loan obligations. These are really bad junk bonds that have been chopped up and diced up like mortgage-backed securities were, like collateralized debt obligations and mortgage-backed securities prior to 2008. And eventually, in my opinion, I've been saying this now since I revealed the research on CLOs. I was the only channel that did the research and found the Federal Reserve research paper. And then I cited other people's work too, as well, other articles. And a lot of these CLOs are made up of covenant-light junk bond debt, over 80% of them. So theoretically, most likely, very high probability that all these CLOs, at least $600 billion and whatever other derivatives are attached to them, could end up all going to zero. And the Federal Reserve might have to do exactly what they did in 2008 and pay 100 cents on the dollar full price for these CLOs from insurance companies, from banks, from pension funds that are actually worthless. Meanwhile, the Wall Street banks and the other people involved in the chain that made this toxic sausage in the Caribbean, but because this stuff is so toxic that they would not even make it here in the United States, they shipped it off to the Caribbean to be made, and then they sent it back here to the United States to sell. So there's a realistic possibility that the Fed may have to eventually buy all $600 billion of the CLOs to expand their balance sheet further, and then whoever bought the CLOs would have to get 100 cents on the dollar, even though the CLOs are worthless. Because that's exactly what happened with the mortgage-backed securities, with the collateralized debt obligations, the MBS mortgage-backed securities, the collateralized mortgage obligations. This is the danger of derivatives. And people are talking about deflation. This is what I'm talking about with rules changes, that the Fed could start doing a bunch of additional currency swaps. There could be additional currency swap lines out to other central banks. There could be all kinds of other craziness. These repo rates could increase massively. They might not even tell us. But we do know that there was, with looking at the story and the zero hedge, there was a ton of different tweets out about this and articles. I have way too many articles here to read. But initially, yesterday, zero hedge, not zero hedge. The Fed tried to offer 75 billion in repo available, and there was some type of glitch, and they couldn't get the program to work right, and they were only able, and then the large banks took 53 billion when the program came back online, and then today there was another 75 billion. So you add that number up, 53 and then 75, and so far in only about 48 hours there is 128 billion in additional liquidity, and we don't know what the Fed bought. So technically it's not QE, because the banks can repurchase the assets, and I'm using air quotes because it could be toxic, could be a CLO, and the banks might never want to see it ever again. Meanwhile, the banks are not benefiting from zero interest rate policy and negative interest rate policy in the European Union. So if the US continues to cut rates, the banks, Christopher Whalen, who is a good hedge fund and institutional bank analyst, he has a free article on his blog website talking about how bank profits have probably peaked, that all the highest levels of profits for banks are in, and that banks, Jamie Dimon and other bank CEOs are extremely bearish now on profit margins and their ability to make profits with zero interest rate policy or worse coming. So in only 48 hours, 128 billion in repo emergency liquidity programs. Pretty insane. So could have been large U.S. banks. It could have been large U.S. banks who have bad counterparty risk, who have counterparties failing on their obligations for derivatives contracts, or my educated guess is it could have been American subsidiaries of European banks here in the U.S. who are drawing that to put out fires, derivatives fires or bad loans fires in Europe. And this is why the banking system is interconnected. Most regular people are not aware of how interconnected the banking system is in the US and Europe. Thank you for the super chat, Vajra. I think we'll eventually be in hyperinflation in the US? Maybe. Here's the thing. So historically, I'm a financial historian and economic historian. Historically, a world reserve currency has never hyperinflated. So I think for sure the US will have really bad worsening stagflation and a lot of tax increases, new taxes at the local, state, and federal level layered on, and also tax increases. Look at what Andrew Yang, the politician's talking about for him to fund his universal basic income. Guys, there would be enormous VAT tax. There would be taxes layered onto everything. There would be taxes increased on everything. For him to raise an extra $3 trillion or so, give or take, per year for his universal basic income, you're looking at just insane amounts of taxes for the everyday necessities. Gasoline, food, buying things online, everything. National sales tax, all that. VAT tax, all the value-added tax, all those things. So historically, there has never been a hyperinflation for a world reserve currency. I think it's guaranteed that the U.S. will have much worse stagflation. And hyperinflation, Vajra, is a psychological event. There has to be citizens that decide that they don't want to hold the currency. So I would look at Venezuela and Zimbabwe, and when people were paid in their local currencies, they decided that they were going to buy anything with it. They were going to buy flour. They were going to buy groceries. They were going to buy almost anything that they thought would retain its value. Toilet paper, good toilet paper, Charmin Ultra Soft, anything that they thought that they could resell at a higher price. No, I don't have a Bitcoin address for donations right now. So we may have hyperinflation, but the problem, Vajra, is that all these governments are all trying to do the same stupid thing. They're all trying to do just absolute stupidity. A lot of the same mistakes, a lot of the exact same mistakes from the 1920s and 1930s with devaluing currencies, tariffs. They know the global economy is weakening very, very rapidly, and they're fighting over the same or larger pieces of a declining economic pie. And we all know what the eventuality was after things went bad after World War I, and the governments did not set the gold price right on the gold standard. They did not set a high enough gold price on the gold standard. And then all the problems happened, and then the reparations that were onerously placed on Germany in the Treaty of Versailles, all those problems. No, I'm not shilling Charmin. I can assure you they're not paying podcast advertising fees. There's no product placements here. So a lot of the same mistakes. Beggar thy neighbor. Donald Trump's trade negotiator, Lighthizer, is going to be increasing more tariffs on the European Union shortly. Either he's announced them in the last couple days, or they're going to be announced soon. We're getting into currency wars and trade wars and resource wars first, and things are going to get a lot worse. Thank you for the super chat, Gavin. Thank you for the super chat, Veritas. And thank you to my almost 150 Patreon account contributors. It's much appreciated. You're making my life a lot easier. And my almost a dozen monthly PayPal contributors. Really helping out. You throw me a tip once in a while, too. One time, that's fine, on my website, wallstreetfrommainstreet.com. That's great. I really appreciate it. So, unintended consequences with the Federal Reserve lowering the interest paid on interest on excess reserves. That money is leaving. So the Fed apologized, saying there was no inflation created since 2008. It's only 1% or 2% with the official stupid government numbers. There is no inflation. There is no asset bubbles. I just saw an interview last week with the CEO of Morgan Stanley. He said there is no asset bubbles. Come on, guys. So the Fed apologists, the big government apologists, the apologists for the status quo are saying all that money, QE created no inflation because all that money was docked at the Fed. Well, now that the Fed's lowering interest on excess reserves, that money is leaving, being docked at the Fed. I have all these articles if you want to read about repos and all the craziness and interest on excess reserves. There's a lot of articles about this from financial professionals who follow this every day. But this is the Twilight Zone, like I said. This is definitely a bizarre world. It's dystopian. And the main rule number one, is government can change the rules. I criticize every single government. All the major governments in power are all changing the rules behind the scenes. China is trying to engineer bailouts where the large banks buy the small banks. That's been their new strategy shift change. They're trying to get all the large banks to swallow up the small banks, and they're hoping that puts out the fires with the bad loans and all the other problems in the Chinese banking system. The Western banking system has done a lot of currency swaps. So not only do you have countries trying to cut interest rates with zero interest rate policy, in the European Union and Japan, it's negative interest rate policy. And then you have other central banks like the Bank of Japan, the European Central Bank, doing QE. The U.S. has not officially started QE. The U.S.'s the Federal Reserve's balance sheet officially increased, I think, $14 billion. $14 billion, guys, is really not that much. Okay, it sounds like a lot, $14 billion, but when you look at a balance sheet that's still like $3.7 trillion or around $3.8 trillion on a relative basis, when you compare 14 billion versus 3.8 trillion, that's not that much. This is a good super chat question by Dimitri. Do I think the next depression... I got a lot of super chats. So thank you, Sega, for the super chat. I appreciate it. Sega Bear. Thank you, Dimitri, for the super chat. Dimitri asks, with all this repocalypse... you call it repocalypse. I think it's repo madness. I think we can have more fun with repo madness. We can use like a goofy, wacky used car salesman, kind of like one of those cheesy commercials that like, everything must go. We'll buy any of your garbage as long as you buy something. We'll buy back all of your garbage, all your toxic garbage. What are the clues for average people as to when to pull the money from the bank? Well, if you're a U.S. citizen, Dimitri, you have $250,000 per Social Security number in guaranteed money that the Federal Reserve, that the Congress will print, the Federal Reserve will print, backstopping you. So as of now, that has not changed. You have $250,000 in coverage across all those bank accounts, and they're going to print the money until that printing press is taken away. So in nominal terms, you will get $250,000 back. As of right now, I think stock brokerages are a good place to place some savings instead of regular banks, because you have the ability then to buy stocks or buy gold exposure. Stock market, stock brokerages also have additional coverage in the SIPC. Now, the SIPC gives you additional coverage, and that is also underfunded, but almost definitely that Congress and then the Fed by default, the SIPC will go to Congress, and then Congress will ask the Fed, and they will just print the money nominally, and those guys will be bailed out too. So those ones will get bailed out in nominal terms. They're going to keep printing the money until the printing press is taken away. Outside the banking system, I like gold money. I think everyone should have either a gold money account or a vaulted account, and they're not real banks. So they store physical metal, and they have gold-backed debit cards. So you have goldmoney.com, and then you have the Vaulted app, which stores physical metal at the Canadian Mint. That David McIlvaney and McIlvaney Financial, that's his new little venture. So gold money would be for regular people if you're a European listener out there and you're worried about the banks charging you negative interest rates, having a gold money account. It's not a bank, so you can have some savings in there. And if you want to buy something with your gold-backed debit card, it just sells gold by the gram for fiat currency, and you can protect some of your savings that way. I mean, you can also have cash outside the mattress. You can have cash outside the banking system under a mattress, but then that's dangerous. There's security concerns there, especially if you're in a country that has banned guns. So if you're hiding cash like in a safe, or you're hiding cash in a mattress, or you're buried it behind the backyard, there's always the risk that if you're gone from the house, that someone was staking you out and looking to steal it. So we're in a scenario now where there's a lot more risk and a lot more danger. So I personally this is not financial advice, just my opinion. I have my own gold money account, and I put some savings into there. Steven says it's $250K per FDIC account. No, they changed it, Steven. After 2008 and 9, they changed it. So it's now, it's not $250,000 per bank account. It's now $250,000 per Social Security. So if you have more than $250,000 in each bank account, you're not going to be made whole. It was changed, almost 10 years ago, around 10 years ago. LIBOR is rising. What does it mean for the credit card, for the credit market? It means the consumer is going to be paying more for a lot of loans. It also means the banks don't trust each other, because LIBOR is short for London Interbank Operating Rate. That means there's more counterparty risk. The banks are not trusting each other, which is very similar to what happened in China with the interbank lending rates. This was predictable. It was a question of when and not if all these banks were going to start to have problems again. I just saw another article that mortgage-backed securities are starting to become popular again. And in the banks, a couple weeks ago, my best friend, who's a successful real estate agent, he sent me a real estate article saying that the banks just got the laws changed, so the banks can now issue mortgages with you don't need proof of income anymore here in the U.S. So there was the laws changed that you had to have a certain debt to income ratio, and your mortgage payments could not be higher than a certain amount of your monthly income. And those laws were in effect after the 2008 financial crisis until very recently, and apparently they just got changed. My understanding of the law, unless they changed it the last time I looked at it, was that the FDIC was guaranteeing $250,000 per Social Security number, which means that they had all the bank accounts with the social security number. And so if you had more than that in each bank account, they were only guaranteeing that one total amount. That's as far as I know. I could be wrong about that. Maybe they changed the laws again. But the FDIC and the SIPC is for stock brokerage account. It's supposed to backstop that. But those are both extremely underfunded. And normally what happens if more than one bank goes to Congress asking for a bailout, let's say one bank fails, Congress, the SIPC and FDIC have problems handling more than one bank at once or more than one brokerage at once. And that's when these agencies, because they're extremely underfunded, they have to go to Congress, and then Congress approves the money, and or the Fed just prints it. So in nominal terms, you may get your money back for the guaranteed amount, but in real terms, in your purchasing power, if they're going to be printing everyone additional $250,000 more, or whatever the stock brokerage account guarantees are, then the value of the dollar, if they keep printing, if the Fed restarts QE and increases their balance sheet again, which is almost guaranteed at some point, then that's going to lower the purchasing power of the dollar. So hyperinflation, the Super Chat question was asking about hyperinflation. It is a psychological event. Velocity of money has to increase. All the measures I've seen for velocity of money are that velocity of money in the United States is collapsing. So there is flight capital coming to the U.S., but it's not buying U.S. goods. It's buying U.S. assets. It's buying U.S. real estate. It's buying U.S. stocks. It's buying U.S. bonds. It's ditching other currencies and going into the dollar. And that's why the trade-weighted dollar index is strong, is at or near an all-time high. I haven't looked at it after it went to 131. I haven't looked at it in the last week or so. Been busy doing other things. And that's why the dollar index is still strong. Do I think the next depression will set off a kinetic war? Excellent question, Veritas. I think it's more likely that we have cyber warfare first, that we have escalating trade wars, and the U.S. and China, I see a Cold War. I see an economic Cold War escalating. There's just too many philosophical differences between the U.S. and China. And China cannot, the leadership in China, in their Chinese government cannot, I'm trying to think of the right phrase here. So when two parties negotiate, both parties have to, there's give and take. Normally both parties have to give in. There has to be a compromise. There we go. So I just don't see the Chinese willing to compromise much at all, the Chinese government, because that means weakness. And if you're a leadership in the Chinese Communist Party or Communist Party of China and you show weakness like that, you're risking being overthrown. Because there's there's a lot of dissent inside at the high level of Chinese politics from what I'm understanding. So I see, first, to answer your question, I see escalating currency wars, escalating trade wars with more tariffs as countries fight over a declining global economic pie, which is very similar to what happened in the 20s and 30s. I see potential resource wars, and I see cyber warfare first. I see the risks of, Jim Rickards talked about this in his new book, Aftermath, and it's just a lot cheaper. The return on investment for governments is just way cheaper to do hacks, to go after countries, power grids, things like that. It's just way cheaper than to go to actual war. It's just much cheaper to hack another country's infrastructure or hack their power plant or things like that, and then for the other country to retaliate. So I think I've talked about this in the past. This is not financial advice, but I've talked about one ETF, exchange traded fund I like, is a cybersecurity company ETF. That's HACK. I think those that ETF was at like $18 when I talked about it, and I think now it's at like $38. So I talked about it about 3 years ago. I can look it up really quick. It's not a cheap stock, but it's a good hedge in case of a war. And all these governments and all these large corporations, whether it's corporate espionage or it's one government attacking another government, or one government hacking a large corporation in another country, or one private citizen or one corporation in another country hacking a government, I see that only increasing. So that ETF, let me look at a 5-year chart. This was at, I think I talked about this when it dipped down into like the low 20s at 22. I think I did a short video on this in the archive, the cybersecurity ETF. I know the guy who started the ETF, Andrew Chanin. He's a big silver bull too. But he has a very successful ETF with this one. It's got a lot of net asset value. And that ETF in 3.5 years, it's gone from $22.49 at the lows up to $38.70 now. So it's had a pretty good run. Yeah, so the types of wars I think we're going to see first are more likely to be cybersecurity. Hacks. So for not financial advice, but if you want to protect yourself, that means that you have to have more cybersecurity defense installed with your family and your home. Isabella says we are witnessing the systematic destruction of the system. Well, this was inevitable. I did videos on this in the last couple of months. Over $65 trillion in additional currency and credit has been created since 2008. It's an insane amounts. That's on the low end. The 65 trillion number I said is only the stuff I could easily prove. If you want to talk on the high end of the estimate, it's over 100 trillion. And that's why we have asset prices the way we are. Especially American asset prices, because there's so much capital coming here. There's a lot of foreign capital that's come to the U.S. And that's why you have real estate prices the way they are in Vancouver and Toronto and Sydney and Melbourne and Brisbane, in London. Every country cannot be Japan. So Japan was the only country doing this, and they were able to export a lot of their monetary inflation. The yen carry trade took away a lot of their monetary inflation out of Japan. Every country cannot be Japan for decades to come. It just does not work that way. Japan was the only country doing this for a long time, for over 20 years. I just don't see this playing out for another 20 or 30 years like this. There's just too much rising populism. There's too many people that are angry, especially after how no bankers were jailed after 2008 and 9. There's rising civil unrest in the European Union, United Kingdom, all over the U.S. People are fighting in the U.S. A lot of my non-American listeners aren't aware of this because they probably get a lot of biased mainstream media, fake news stuff. But there's just massive amounts of infighting here in the U.S. on lines of race, gender, class, age. It's increasing massively. The last 10 years, it's increased to levels I've never seen before. And it gets worse every year. I live in an area where 90% of the people in Washington, D.C., around 90% of every election votes just hardcore Democrat no matter what. Michael says politically correct culture killed the U.S. Yeah, I agree. Cultural Marxism. Well, actually, Michael, this was the plan the Soviet Union had to collapse the U.S. from the inside out. It just took decades longer than the Soviets thought it would. The Soviet Union collapsed before they could collapse the U.S. with this. Isabella says the yields in Europe are mostly inverted. The central banks want them inverted. This is financial repression. The central banks either want them inverted or don't care if they're inverted. Financial repression benefits the large over-indebted governments in the U.S., the European Union, Japan. It benefits those the most, and it also benefits the zombie companies. The companies that can never pay back their debt, and the lower the interest rates go, the easier it is for these zombie companies to continue to refinance their debt and stay alive that way. So they always have solvency issues, these zombie companies, and they were lent way too much money, and they can never pay back their debt, and they're still being given money to borrow because interest rates are going down, and there's always creative financing available, even at penalty rates, and they restructure their debt all the time. Jerry says Japan is to economics what politically correct culture is to society, total paralysis, but the big guys prefer this to chaos. Also, Jerry, they can re-engineer, socially engineer society during this. So they can do it gradually. They don't have to do everything all at once. Things have changed a lot in 10 years since in this area. 10 years ago, I don't remember things being anywhere near this bad. When I was in college, and that wasn't that long ago, I used to go on dates with Democrats. I wasn't a libertarian then. I wasn't really that political at all. I just know I wanted to be entrepreneurial and own my own business someday. And I was interested in the stock market. I had not read any stock market books. I was reading articles. And I wasn't political at all in college. And I was going on dates with Democrat women, and they weren't wanting to scream at me that I didn't have the same politics as them, and they weren't talking about, castrating me or killing me or anything. And there was no problems with that. Politics weren't even really discussed that much. And now it's, if you don't have the right politics now, you don't even get a date anymore around here. And if you do get a date, then then you could get really screwed over like me, where the date doesn't look anything like her pictures and is over 50 pounds heavier than her pictures. So I'm not going to make that mistake again. I guess then I have to do a FaceTime chat now and make sure. It's ridiculous I have to do this now, all the checks and balances that have to get done. Am I an Ayn Rand fan? Yes. I don't agree with everything Ayn Rand says, but I've read Atlas Shrugged and The Fountainhead. She has a lot of good points. I don't agree with everything she says, though. She doesn't like Ludwig von Mises and Murray Rothbard. She doesn't like the Mises Institute people. Marpser says, I got fat-fished. Yes, I did get fat-fished. But luckily I didn't spend that much money. And I can't go into any more details because they're not safe for work. Okay, one more super chat. Let's see here from Veritas. Mark Cuban said that technological advancement will allow us to grow infinitely. What do I think about that? Well, I think Mark's a billionaire, and I think the increasing stagflate and tax and lie doesn't affect him. So when he's a billionaire and he has everyone offering him deals and the chances to make more money, he's totally divorced from reality. He's totally divorced from reality. So for him, he sees a bright future. For the average person, putting food on the table, rent, medical bills, healthcare, all those things, gasoline in the car, their bills are going to go up, and the average person has enormous amounts of student loan debt. So I don't think Mark Cuban understands what the average person is going through at all. There will be technological improvements, but they're not going to offset the stagflate and tax and lie that is happening to all the everyday items, the consumer staples, food, rent, gasoline, healthcare, education, all the things that everyday people, regular people need. So now that Mark's a billionaire, he can make these claims. So I think there will be technological innovation. However, there's not nearly as much innovation as there should be because a lot of capital. Look at Apple. Apple is doing financial engineering. Apple should be creating new products and services. Apple is not creating nearly enough new products and services. Instead, Apple is sitting back on their moat, paying a dividend with cash in their balance sheet, using debt, issuing more bonds, doing financial engineering. So I don't like Tim Cook very much. I think he just sold a bunch of his shares. Apple needs to create more products and services. Steve Jobs was good at it. Tim Cook has not been. Albert says Apple is copying Huawei. Yeah, for some of their things, but the Chinese technology companies copied Apple and Google and didn't pay any money for their intellectual property. So Apple is living off their old economic moat that Steve Jobs built, and Apple's only business strategy, they better start creating some new products and services fast, because if they keep raising prices on their iPhone, eventually the marginal consumer is just going to say, you know what, I can't pay $2,000 for a new iPhone. Although I was just at getting a new phone myself. Well, new for me. It wasn't the most brand new, but it's still, I got it for a really nice new phone for slightly used for under $200 cash. And I can tell you that the average person is not paying all cash for the guy at the Sprint store where I bought my phone. He was shocked that I wanted to pay for all the phone up front. Okay, people are not able to pay up front. It's all financing. So it's all, oh, for an extra $10, $7, $10, $20 a month, you can add all these things. And I was like, no, I don't want to pay that, because then it's going to end up being more money. I'll just pay it all up front now. The iPhone went down in price, maybe the old iPhones. Did they lower the new iPhone's price? I thought the new iPhone that just came out with all the bells and whistles was $2,000 with the most memory, with the most gigabytes in the hard drive. So the average person on Main Street does not have enough money to go into the phone store if they want a new phone and pay for all the phone up front. Because either they have too much debt on their credit card and can't afford to do that, or they don't have enough cash in the bank account, and so they want the new phone and they're willing to pay $20 a month for years. Another thing that the mainstream media is not mainstream financial media, mainstream media analysts who cover regular Wall Street are not talking about. So everything's financed. Even a cell phone now is financed. Timothy says Apple is the new BlackBerry. Yeah, it's looking like Apple's moat is declining. They really need some new products or services. You need new products or services that have intellectual property and that also have higher margins. And Apple has lost a ton of market share in China. Apple used to be in the top 3, I think, in smartphone sales in China. They're now number 6 or number 7, depending upon which survey, and they're falling like a rock. So all their growth markets, Apple is getting killed. I'm not advocating shorting Apple. This is not financial advice, but at some point, Apple's business model, they have to come up with new products and services. And I don't think Apple's content, their streaming service that's trying to copy Netflix and Hulu and Disney Plus, I don't think it's going to be very good. No, Google's actually innovating. Google has a lot of venture startups, and Google's investing in robotics. Google's investing in AI. Google's at least trying. Google is trying to innovate. I don't know how successful they're going to be in some of those other ventures, but they're at least trying. Google is way more innovative than Apple, although Google's very draconian with their political stuff. Did you just see the new announcement from Facebook that there's going to be an oversight board now for content approval? Ugh. I'm not as familiar with Microsoft. Samajas, a lot of mining in a lot of foreign countries is not environmentally friendly. There's still a long way to go in a lot of developing countries as far as the protecting the environment goes. Rare earths mining in China was unbelievably bad. That's how they bankrupted all the other rare earths miners in the U.S. with Mountain Pass a long time ago. I understand that China's trying to clean up the rare earths mining, but I'm not sure how much of a cleanup job they've done on it. Okay, guys, well, we're almost at 50 minutes. I'll be on here for another couple minutes, and that's it. My voice is starting to go. So I have all these articles. If you want to read more about the repo stuff, there's articles from hedge fund managers, articles from financial professionals who pay attention to this all day, but it's technically not QE. So it is an emergency liquidity program. All the talking heads in the mainstream media, mainstream financial media, all the regular Wall Street people that make a lot of money off the status quo, they will say this is not QE. They're screaming that this is not QE and that the Fed only lent the repo on good collateral. But the truth is we don't, because the Fed is not being audited. There is no independent audits of the Fed. We don't know if this is really quote unquote good collateral. This could be toxic garbage CLO, that's collateralized loan obligations that are blowing up now. Veritas says with his super chat he's been buying mining stocks every dip. Yeah, if I had more money coming in, if I was actually making more money from this podcast and my content and some other stuff, I would be buying more shares of Sandstorm Gold. I think it's a really good buy. Just my opinion, not financial advice. I would love more shares of Sandstorm Gold below 6. I think it's a bargain. They have a lot more royalties and streams coming online in the next couple of years. There's a lot more growth. They're making really good money at these prices, at these gold and silver prices. It's a really good company. It's funny that the stock's down because operationally the business is generating record amounts of revenues. They're almost up to $100 million a year in revenues. And yet the stock price is down. Go figure. In my opinion, it's a buying opportunity. Okay, I'll look at listener questions and comments for another minute or two, and then that's it. My voice is close to going. There's debts and defecation says pull your money pull your money out now out of the banks. So there's trade-offs with that. There's trade-offs with pulling all your money out of the banks. Where are you going to safely store your money? Are you going to buy a safe? Are you going to buy safes to store your money? Because if you buy a safe, then there's ways that people could get in and steal your safe. Are you going to have guns and ammo to protect your safe? There's all these other trade-offs and risks and other security measures that you have to install. And yes, it sucks that we have to do this, but in the new normal, we're in a really dystopian new normal now. And it's been getting worse for a while, where the people in power, the economic and political elites, can change all the rules, sometimes without even telling us. And we're going to have a lot of rules changes going forward. At some point in a lot of these countries, and Australia is already being talked about now, they might go full cashless. Dimitri, thank you for the super chat. I don't care if it moves in the short term. I don't care if it moves for months. I'm looking for those big assets to come online generating cash flow, and I'm looking for big price increases. I don't care about the short term. I'm looking for doubling, tripling. I've already doubled my capital in Sandstorm on a lot of my shares because I was buying in the 2s and 3 range. There's a lot of, if you pull all your money out of the banks and you buy lots of gold and silver, you have to remember that there's other security measures that you have to install. Because the average, I've heard stories from people that they bought a lot of gold and silver and then they tried hiding it in their house. And then when they had workmen or repairmen over, or even family members, when they had like a party or a family get together, people would steal the metal. Unfortunately, everyone is trying to hustle and lie and cheat. And not everyone, but almost everyone is trying to lie, cheat, and steal to survive. And people are even willing to steal from friends and family members to try to get ahead or survive. Not everyone's doing this, but there's an increasing amount of people that the level of morality, the level of ethics and morals in society is just declining. No, I don't think Sandstorm Gold will pay a dividend soon. I think they're reinvesting their cash flow into more deals. They're looking to add more cash flow. I think they'll pay a dividend in a couple years. They have enough cash flow where they can buy back shares, and they're also, most of the cash flow, though, in my opinion, will be for new deals for growth. This is a good time because most